Alright, traders and future financial conquerors, buckle up, because today, we're diving into a strategy that's got everyone talking, the Martingale strategy. But hold up, this isn't your average follow the crowd tutorial. Nope. Today, we're breaking down when and why you should apply this strategy, and more importantly, when you shouldn't, so you can take control of your trading game like a pro. Here's the deal. This video isn't just another trading guide. It's your roadmap to mastering independent thinking in the trading world. We're talking about honing your skills in technical analysis, spotting trends, and making decisions based on a full picture of the market, not just chasing a single shiny indicator. If you want to succeed in trading, you've got to stay cool, calculated, and crystal clear on your money management. But here's the twist. I'm not leaving you to figure this out alone. My team has developed a game-changing trading assistant, a free robot advisor that works smarter, not harder. This bot collects real-time indicator data, crunches massive amounts of information, and serves up insights in a clean, easy-to-read format. Whether the market's heading up, down, or sideways, you'll know exactly which way to trade, all in just 2 clicks. And here's the kicker. You're not just getting the bot. You'll also unlock an exclusive promo code for a 100% deposit bonus. That's right, deposit $50, and you get $50 on top. Deposit $300? Boom, $600 in your account. Just a heads up, this promo code works on your first deposit only, so don't sleep on this. By the end of this video, you'll not only understand the Martingale strategy inside and out, but you'll also walk away with the tools to make smarter, faster, and more confident trades. So if you're ready to stop guessing and start growing, make sure you're subscribed to this channel. Hit that button right now and let's get started. Alright, let's dive into our first trade. We'll check the indicators, analyze the setup, and make a final call on entering the trade. I'll be pulling recommendations from 2 time frames, 5 minutes, since that's my go-to expiration time, and 15 minutes to confirm the trend. But here's the thing. Don't blindly trust recommendations. To succeed, you've got to mix them with your own analysis. Now, all the signals are leaning towards an upward move, but there's a catch. It might be overbought. That's why we've got a backup plan ready. The Martingale strategy, just in case things don't go our way. Looking at this chart, there are several indicators screaming go long. First off, the price is moving within a clearly defined upward channel, and it's currently bouncing off the lower boundary of that channel. This suggests strong support and an expected move upward. Next, the stochastic oscillator is coming up from the oversold zone, indicating a potential reversal and upward momentum. The MACD histogram is also showing increasing green bars, signaling bullish momentum is building. The ADX lines, particularly the directional movement indicators, suggest the trend is strong and in favor of the buyers. Finally, the 76% payout ratio for this trade sweetens the deal. Combining these technical factors, trendline support, bullish oscillators, and strengthening momentum, this setup justifies entering a buy position to ride the upward movement. Building on the earlier analysis, this chart reinforces the bullish case. The price is in a clean uptrend with higher highs and higher lows, a textbook example of trend continuation. The volume bars show consistent engagement, backing the upward momentum. The stochastic oscillator, though near the overbought zone, hasn't signaled a reversal yet, indicating there's still room for the trend to run. Combined with the channel breakout potential, this setup aligns perfectly with a trend-following strategy. By leveraging these signals together, the probability of capturing additional upward movement increases, making this an ideal spot to enter a buy position and ride the ongoing bullish wave. The chart shows that the price is starting to drop due to several signals indicating a weakening of the bullish momentum. First, the stochastic oscillator reveals overbought conditions. This is a classic sign that buyers are losing strength and the market is preparing for a pullback. The MACD confirms this shift as well, with its histogram shrinking and the signal lines moving closer to a crossover, which often hints at a reversal. Additionally, the ADX is showing a decrease in trend strength, suggesting that the bullish trend is losing steam and a downward move or consolidation is likely. Price behavior also suggests demand is fading. possibly due to hitting a local resistance level where traders are taking profits. Together, these factors create a clear setup for a price decline or at least a short-term correction. Looking at this chart, it's the perfect scenario to use the Martingale strategy. For those unfamiliar, Martingale is all about doubling your trade size after a loss to cover that loss and make a profit once you hit a winning trade. The idea is simple. When you eventually win, the payout not only recovers your previous losses but also gives you a net profit. Then, you go back to your original trade size. Here's why I think it works here. First, the market is showing a steady downward move, but it's not a sharp drop, it's controlled and gradual. That tells me we're not in some chaotic trend where the price could spiral endlessly. Plus, the indicators like stochastic and MACD are signaling weakening momentum. Stochastic is already oversold and starting to hint at a potential reversal, and MACD is showing signs of divergence. The ADX also confirms that the trend is losing strength. All of this points to a likely bounce or pullback soon. Now, here's how I'd apply Martingale here. Let's say I started with a $800 buy position, but the price dropped and that trade lost. Instead of panicking, I double down on the next trade, increasing it to $1,600. This ensures that when the price eventually bounces back, and the indicators suggest it's going to, I'll not only recover the $800 loss but also lock in a profit thanks to the payout percentage. The key is staying disciplined and only entering when the next setup looks solid, like a clear reversal signal. What makes this strategy effective is how it works with probabilities. Markets rarely move in a straight line forever, especially in situations like this where momentum is fading. That's why doubling the trade size on each loss increases the odds of recovering. But let's be real, you need a strong bankroll and discipline to pull this off. If you over-leverage or ignore the signals, you'll blow your account. So, for me, this setup screams Martingale. The price is nearing a point where buyers are likely to step back in, and the indicators are aligning for a bounce. With proper risk management, this strategy can turn losses into profits in a situation like this. This Martingale setup worked perfectly here because the market showed signs of exhaustion after a steady drop. The stochastic oscillator hit oversold levels and started turning upward, signaling a potential reversal. Combined with fading momentum on MACD and ADX, the timing aligned for a strong recovery, ensuring the higher trade succeeded. Alright, time to check out our second trade. This time, we're diving into the currency pair, the US dollar and the Canadian dollar. Let's see what the market has in store for us today. We'll start with a quick analysis to get the lay of the land, and then we'll jump into an interesting topic. Most of the indicators are pointing towards a buying market rather than selling. Sounds good, right? But hold up, I'm spotting some red flags here. Overbought conditions are creeping in, and the longer the time frame, the higher the risk. Always worth keeping an eye on those details. Here's another red flag, a concerning consolidation zone near the recent local high. That's a big hint that buyers might be running out of steam. In simple terms, the price has hit a peak where no one's willing to buy anymore, which means a correction is likely on the way. So, without hesitation, I'm opening a short trade. Stick around, I'll break down the rest of the details during the analysis. At the moment of entering the trade, I spotted key signals indicating a sharp drop in the US dollar to Canadian dollar pair. First, the price hit a strong resistance level where it had previously reversed. Second, the stochastic oscillator showed overbought conditions, signaling a potential downward correction. Lastly, the MACD indicated a sell signal with divergence. These combined factors suggested that buyers were losing strength, making a decline in the price highly likely. When you look at this situation, it's clear the price couldn't push higher, even after multiple attempts. This tells us the buyers are running out of steam. It's like when someone keeps trying to break through a locked door. They hit it over and over, but eventually, they just give up. Once that happens, the sellers usually step in, and the price starts to drop. It's all about balance in the market. When one side gets tired, the other takes control, and here, it looks like the sellers are ready to take over. Think about it. every market move is like a tug of war between buyers and sellers. In this case, the buyers have been pushing the price higher, but every time they hit a certain level, they get stuck. That resistance acts like a ceiling they just can't break through. Over time, this kind of struggle shows the buyers are losing their grip. And once the first few sellers step in, it creates a ripple effect. Other sellers see the opportunity and start jumping in, driving the price lower. It's not just about technical analysis, it's psychology. Traders see prices struggling at the top and begin to doubt the upward momentum. Fear of losing profits kicks in, and they start selling, which only speeds up the decline. Add to that the fact that buyers may hesitate to jump back in, waiting for a clearer signal, and the downward momentum builds. Markets thrive on perception, and here, the perception is shifting away from strength to weakness. Once that shift begins, it can accelerate quickly. The Martingale strategy is fascinating for how it divides opinions. On paper, it seems brilliant: double your bet after every loss, and one win recovers everything. But in reality, it's a financial tightrope walk that assumes unlimited resources, money, patience, and time. Losing streaks happen more often than we'd like to admit. Markets are unpredictable, and as losses escalate, the stakes quickly become enormous. After 5 or 6 losses, the pressure alone can cause even experienced traders to hesitate, often leading to failure. Casinos, where Martingale originated, introduced betting limits to counter it. Even without limits, most players run out of money before they recover their losses. Trading is even riskier. Markets aren't 50-50 like roulette. Trends and volatility can push odds against you, wiping out your account before you get a chance to win. Some traders tweak Martingale with smaller bet increases or filtered signals, but it still relies on luck and assumes ideal conditions. Its real value lies in teaching risk management and probabilities, not guaranteed profits. In the end, Martingale is a cautionary tale. While it might work for short-term wins, its risks far outweigh the rewards. Markets reward discipline and risk control, not blind gambling. By the way, have I mentioned that by starting to use our free bot, the best assistant for any trader in market analytics, you'll get a personal invitation to our exclusive VIP chat? In there, I provide in-depth analysis and share proven trading signals just for you. Don't miss this opportunity. But that's not all. We're running a contest where you can win $1000 just for leaving a comment. The rules couldn't be simpler. Watch this video till the end, give it a like, subscribe to the channel, and leave one comment about trading below this video. I'll pick 2 winners using a randomizer, and the results will be announced in our Telegram channel. By the way, our Telegram community is packed with valuable trading knowledge and tips from our team to help you learn and succeed. The link to join is in the description. Make sure to subscribe. The best part? This contest happens every week, so you always have a chance to win. Good luck! The market is like a living organism, and no tool, no matter how advanced, can account for every nuance. Imagine your trading tool recommends going long, but you notice clear signs of weakness. The price is hitting strong resistance, volumes are dropping, and indicators are signaling a reversal. Relying only on algorithms is like driving a car without looking at the road. By analyzing the market yourself, you learn to spot these moments and make decisions that tools might miss. Remember, your greatest trading tool is your experience and intuition. Sometimes, going against the recommendation is the smartest move. Well, that's a wrap for today. We had a successful trading session, took a deep dive into the Martingale strategy, and even tested it out in action. Hopefully, this gave you some new insights into how it works, and when to be cautious. Now it's your turn. Drop a comment below with your thoughts or let me know what topics you'd like me to cover next. Whether it's trading strategies, market analysis, or something completely different, I'm all ears. Don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss a new video. Your support means the world and helps us keep creating valuable content for you. Thanks for watching, and I'll see you in the next one.